Good day, fellow investors. We analyzed Nike in June, discussed the valuations, the risk, rewards. A lot of questions came from Adidas, and as I'm going to research and we already pulled the data, I said, okay, let's analyze and compare the two stocks. Valuations are relatively high, growth stocks, emerging markets, focus, etc., etc. But there are three topics that are key when it comes to investing in such stocks. So let's start with this very interesting analysis, also touching on a European stock to compare it to an American stock to see the different valuations. And as in this Bloomberg article, they discuss how big investors are shifting from the expensive US to cheaper European stocks. So that also will give you something to think about. Adidas is better from an fundamental perspective and all other risk perspectives, but there are other things that are perhaps more important than just the comparison between Nike and Adidas. And those are that these are growth stocks where a certain rate of future growth, long-term growth, 5 to 7% is already priced in. If that growth doesn't happen, then you're in trouble as a shareholder because valuations are high. So the question is, do fundamentals matter at all? And then there is also the discrepancy between the American company financial engineering pushing the stock price higher, stock options with Nike, and the more conservative European style managed company. Very, very interesting. A lot to learn and to understand about businesses. So let's start. So let's compare the stock prices. Here you have Adidas, the orange, Adidas, the orange line, and you can see how it's up, 287% over the last 5 years, while Nike is up 95%. Still good, but Adidas has outperformed Nike, and my thinking is that it will outperform also in the coming 5 to 10 years because the fundamentals and a lot of things are on Nike's side. Why did Adidas outperform Nike that much? Well, these are net profit margins. The blue net profit margin, and here you see the trend line over the last 10 years, is Nike's. So Nike went from double-digit profit margins to lower profit margins, closer to 6%, a little bit higher 2019. At the same moment in time, Adidas, the orange one, went from low single-digit margins, 4%, below 4%, to 8%, which is even higher than Nike's. And this is what created the discrepancy in the stock prices because Adidas's earnings quadrupled, quintupled, while Nike's remained closer to the growth line and even declined in respect to net profit margins. Let's first make a sector analysis, then go to the fundamental comparison, and then also discuss the investment conclusion. So, sector analysis. We had about 80% of the global store fleet closed, more than 70% in April due to COVID. However, that turned and we are already at 92% of the global store fleet open at the end of July. That's very positive for business, which means it's likely that sooner or later it will be business as usual for the companies from a sector analysis. Also, online e-commerce for the businesses really exploded. We have 93% higher for Adidas in Q2. So huge online boost. So as customers get used to buy more online, that's also a benefit probably for companies if they can have higher margins. But also, retail is extremely important because North America sales for Adidas fell 37% despite triple-digit e-com growth. So yes, e-commerce is important, but not yet. And then what's the main sector investment thesis, the thesis the companies are playing on? So here you have middle class, more middle class. It means more shoes, more Nikes. I remember when I was poor, we would buy $5-10 shoes, no brand, no nothing. Then later, late 2000s, we started to buy constantly branded shoes because that was the trend. That's what you had to do probably. But much more sales as Croatia emerged economically, and there was I living for. As we are now at 3.5 billion people in the middle class, as that grows to 5.5 billion in 2030, so over 10 years, that's 2 billion more customers for the companies. That's probably double the market, especially as the trends grow. So that's 5 to 7% growth for the companies just from market growth, and that's what they are playing on. That's the main investment thesis for both companies. But there is one risk that I have found, and that's very, very curious. UBS made a research on TikTok. Now we are starting to talk TikTok, but that's how the world is now. And they looked at likes, and these new brands, Pretty Little Thing, Shine, Gymshark, Fashion Nova, each one of these brands had more likes on TikTok than Adidas, Lululemon, Skechers, and Nike combined. So yes, it can be a risk that the trends are shifting towards new things, as those are, let's say, more flexible in the internet world. Something to watch, because if the expected growth that's here, 5 to 7% for the market, isn't 5 to 7%, is, let's say, 2 to 3% over 10 years, that will have a huge impact on stock prices, because the fundamentals now, the stock price, is pricing in high single-digit growth, not low single-digit growth. And that's also the risk for the investors. Something to keep in mind. When it comes to market share, nothing worrisome there, because all those companies have stable market shares. We have Nike with 16%, Adidas with 11.7%, just a little bit lower. 2017 Nike also straight at that level, a little bit lower, a little bit higher, but we are very, very stable when it comes to market share. Now, let's discuss fundamentals. Adidas wins on the fundamental base, on the risk base, you will see, but you will also see why it might not matter if you're a Nike or Adidas stock investor now. So if we look at revenues, there were some acquisitions in the past, so some of this growth is from acquisitions, but if I look over the last 15 years, pretty equal growth rate, so the companies kept their market share and grew accordingly. However, there is one small little thing there, something to just keep in mind. Nike, last year, as online sales grew, decided to account for a sale when they ship the shoe. However, Adidas is still accounting for the sale when actually the customer is not returning the shoe. So, online sales, your spouse probably orders 3 shoes, tries them on, returns 2. Nike says it sold 3 shoes. Adidas would say they sold 1 shoe. And 1 pair of shoes, sorry. 1 pair of shoes. So that's something very peculiar. Are those tiny details that over the long term might make a difference, especially when things turn for the worse? And are those risks that in an analysis, in a stock analysis, pile up? And if you are doing this for a long time, you see them and you say, okay, risk, and that rings a bell here and there, or raises a red flag. Now, let's do the fundamental quick analysis. Price-earnings ratio, Adidas is much better, so Adidas wins there. Debt also, Adidas has 1.6 billion euros, Nike 9.4 billion. And on top of everything, there is also something else that, again, a peculiarity with these businesses. So 1 billion deal for Cristiano Ronaldo. And if you look here at endorsements contracts, those are in total 9.3 billion already. Long-term endorsement contracts, 1 billion per year over the next years, that they already know that they have to pay in the future, no matter what happens to these sport players or not. In total, the debt, the future liabilities, end up to 35 billions, which is significant, especially as the long-term debt was much smaller just a year ago. So that's again something to think about and see as a bell of risk, a ringing risk bell, just to watch carefully over time. Because Nike was also a very low debt business like Adidas, and now it's a little bit higher. But if Adidas also takes 10 billion in debt and pays dividends, does buybacks, then the stock will also outperform. That's the financial engineering that we are discussing and always having to keep an eye on. When it comes to investment returns, if you look at the price earnings ratios, Adidas 26, 100 divided by 26, the return, the fundamental return is 3.84%, for Nike is 2.32%. But if we assume equal growth, equal market growth for the companies of 5%, attach that growth onto the above returns, we have returns that are expected to be at 8% and 7.42%. Not a big difference, you would say, because the market can always change its mind. So over the next 10 years, I don't know whether Nike or Adidas will win the investment game. Long term, Adidas, all things equal, should win, but shorter term, which can be 10 years, it's really difficult to know because of this. Cash and cash equivalents with Nike doubled over the last year, their debt tripled, which means that they are using financial engineering, and when a company starts to use financial engineering, in the short term it might do really well, but when bad things happen, it can really backfire. So that's the conundrum there with Adidas and Nike. So the risks of investing in these companies are, those are growth stocks, because the growth is what is priced in. Let's say 5 to 7% growth over the next 2 decades, and if the growth is higher than expected, the stock will give even higher returns, no matter the valuation and no matter whether Nike or Adidas. If the growth is lower than what is priced in, then what are the market's expectations, then the returns to shareholders can be very negative. And that's something to watch, carefully watch, understand the market, how things go. Then, also, fundamentally, you would say price earnings ratio 43 of 26 is exuberantly high. But when you compare a dividend yield of 1 or 2% to what you get in the bank, which is 0, I think, right? When you compare them, then the dividend is stellar, plus the growth, plus the business, plus whatever comes alongside such investment. So it's also depending on where the money flows. If money starts flowing from the US to Europe, because European stocks are cheaper, and please subscribe to this channel because I'm doing now Austria, we'll go into miners, railroads, but we'll also touch on 30-40 good businesses in Germany. So if you want to hear more about those analyses, please subscribe to this channel. Also, let me know in the comments which stocks do you want to hear, because I always like to hear about them. I will be doing Intel likely on Wednesday, so also click that notification bell so that you get a ring when the video is out. Back to fundamentals. So depends on what are the market's valuation when it comes to those returns for you. But of course, if you pick Adidas, the risk that something changes there might be lower than with Nike because of the different valuation. Nobody knows what will happen. This is just investing, which is risk versus reward, comparing what is out there and seeing what's better for your portfolio. Also, with the debt skyrocketing with Nike, as long as things are good, as long as the company manages to increase cash flows, to be profitable, to have high net profit margins, everybody will say that debt is okay, the debt is minimal, the debt is manageable. Especially with low interest rates, I believe for Nike is 2.5% approximately for all the debt of 9.5 billion. So that's really nothing. 10 billion, 2.5% is 250 million. They probably make that cash flow in 1 month. So really easy to manage. The problem with that starts when things get bad. And sooner or later, for every business, it's likely that things will get bad, and then the backfire process starts. So that's another risk that I attach more to Nike in comparison to Adidas. I hope you enjoyed this video. Please subscribe. Let me know in the comments what you think. What are your thoughts, long-term investments? Also, if you have any stock ideas so that I can put them on my analysis list so that we always keep this channel interesting and value-giving to you. Thank you, and I'll see you in the next video.